400 years ago, a single company didn't just trade goods. It created the world's first stock market and the first financial bubble in history. Investors made fortunes, then lost everything, all because of a bold gamble on ships, spices, and a dream that seemed unstoppable. And if you think this is just a history lesson, think again. The same greed and overconfidence that sank the Dutch East India Company is still alive in markets today. It's the early 1600s. The Netherlands is a rising economic power, thanks to its merchant ships and strategic location. But the real gold mine isn't gold, it's spices. Nutmeg, cinnamon, cloves. Goods so valuable that a small bag could purchase a herd of livestock. By the turn of the 17th century, Dutch merchants were locked in a cutthroat race for the riches of the East Indies. Dozens of small companies were sending ships east, outbidding each other for spices, driving purchase prices sky high and flooding Europe with more nutmeg, cloves, and pepper than it could sell. According to historian Jaap ter Haar,
they were sailing the coins out of each other's pockets and the shoes off each other's feet.
To put an end to this costly chaos, in 1602, the Dutch government grants a group of wealthy merchants an exclusive 21-year monopoly over all trade routes to Asia, an unprecedented privilege at the time. This new company is called the VOC, better known as the United East India Company. With the blessing of the Dutch government, the VOC was no ordinary company. It could send fleets across oceans, strike its own coins, establish colonies, and even wage war. It was, in many ways, a state within a state, one with the power to shape the destiny of nations. But there was a problem. Running a global trading empire was expensive. Ships had to be built, crews hired, and faraway outposts stocked and defended. Instead of turning to a king or a handful of rich families for funding, the VOC tried something radical. It sold shares of the company to the public. For the first time in history, everyday citizens, not just the nobility, could invest in a business and share in its profits. Soon, the Amsterdam Stock Exchange is built, becoming the first organized marketplace for trading shares. In August 1602, more than 1,000 investors joined what we would now call an IPO, the very birth of the modern stock market. The gamble paid off. By 1669, the VOC was the richest private company the world had ever seen, commanding over 150 merchant ships, 40 warships, 50,000 employees, and a private army of 10,000 soldiers. It was paying dividends of 40% on the original investment, and its stock was worth the modern equivalent of nearly $8 trillion. By the mid-1600s, the Amsterdam Stock Exchange was booming, and so were the coffee shops and taverns around it. Traders formed tight-knit clubs, meeting regularly to swap news, rumors, and tips. In these sub-markets, information was currency, and the most reputable traders had an edge over everyone else. But here's the twist. People weren't just buying VOC shares to collect dividends anymore. They were buying them to sell later at a higher price. This was the birth of the secondary market, and with it, speculation. In an age where a voyage to Asia could take more than a year, solid information was scarce. That left room for rumors to drive wild price swings. One week, whispers of a captured spice port sent shares soaring. The next, news of a lost ship sent them tumbling. The market became a roller coaster. Early investors make fortunes, and word spreads fast. Soon, everyone wants in. Merchants, shopkeepers, even servants pooling their savings. Prices soar far beyond what the company's actual profits could justify. The logic becomes, if prices have gone up this much already, they must keep going. Some traders even borrow money to buy more shares, the 17th century version of margin trading. It works for a while, but it also means that if the price falls, these investors will owe more than they own. Reality finally catches up. A series of bad voyages, naval battles with rival powers, and falling spice prices hit the company's profits. Suddenly, that guaranteed growth doesn't look so certain. By the early 18th century, confidence is slipping. After 1730, the decline accelerates. Investors rush to lock in gains. Selling triggers more selling, and panic spreads, and those who bought with borrowed money are wiped out. The stock market party is over. VOC shares sink toward their true value. The company itself limps on for decades, but the dream of endless riches for all shareholders is gone. And the world has just witnessed one of the first great financial bubbles burst. The VOC's story is a reminder that bubbles don't happen in isolation and they don't disappear from history. Even while the company's ships still dominated global trade, the Dutch experienced the tulip mania in 1637. In the centuries after, the pattern repeated. The South Sea bubble in England, the 1929 crash in America, the dot-com boom and bust, and more recently, the speculative frenzies of meme stocks, crypto, and NFTs. Technology changes, markets evolve, but human nature, the mix of greed, overconfidence, and the hope of getting rich quick, stays the same. And as long as it does, there will always be another bubble on the horizon. The lesson is simple: don't get swept up in hype, and understand the value behind what you're buying. And never invest more than you can afford to lose. 4 centuries ago, investors in Amsterdam believed VOC shares could only go higher. They were wrong. History doesn't just repeat itself, it rhymes. The Dutch East India Company's bubble was a warning we've been ignoring for over 400 years. If you enjoyed this dive into history and finance, hit like, subscribe, and tell me in the comments which financial story you want to hear next.